Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's September 8th, 2013. We got the expected bounce in the market last week, thanks to a number of factors, not least of which was that the markets were short-term oversold. A good number from a purchasing manager survey on Tuesday helped sentiment, although the enthusiasm was tempered by the lukewarm nature of the responder comments about their businesses. And it looks like any action on Syria is going to take some time, which also helped the rebound. And then on Friday, the jobs report gave the markets hope that Goldilocks is back in the house. It wasn't out for more than a few minutes before I heard someone say, not too hot, not too cold. The estimate of 169,000 was at the lower end of expectations, but it wasn't a shocker. The real surprise came from a substantial downward revision to July, along with a smaller one to June. That raised hopes amongst traders that maybe the Fed will have to postpone plans to announce a slowdown in quantitative easing at its September meeting in 10 days' time. Well, it's a valid point. If you look at the latest payroll data over the last 3 months, there is now a slowdown visible in the labor market. We're still adding jobs, but the July dip takes that 3-month average down to 148,000. Although if you take out July, the average over the other 2 months is 170,000, which sounds a lot better. It's a quandary for the Fed because 170,000 is still below the 200,000 replacement rate level. The unemployment rate did fall to 7.3%, but that was all due to people dropping out of the labor force. The household survey that calculates the rate also showed a decline in the number of people working. The Fed has said that it wants to be data dependent with its decisions, but the data weren't supposed to be softening either. Another purchasing manager survey did print a multi-year high on Thursday, but the Fed is supposed to be focused on employment, not purchasing surveys that aren't the most reliable indicators. So what does the Fed do? Well, a mini taper is a possibility. A small cut of maybe $10 billion or so a month appeals on the grounds that it would get the ball rolling, maintain some Fed street cred, and maybe even inspire a relief rally. There's also an August retail sales report coming out Friday, before the Fed's next meeting, and that could influence things, not to mention Syria and the price of oil. There's also the argument that quantitative easing isn't really doing anything anymore for the real economy, beyond pushing stock and bond prices around. Well, the bank is never going to admit something like that out loud, but the governors do know how to read the papers. So we're back to the waiting game. The Syria situation could drag on a bit longer without any resolution. Any delay should be helpful for stocks. The kind of bad news from the job report was kind of good news for stocks, so the same thing might happen if the retail sales report is soft also, although I'm not making any predictions about it. I'm just going to wait and see what the policymakers actually do, and you might want to do the same. I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.